31st of August 2022. I just want to make clear again that this is not financial advice. And I don't just mean that in the legal sense, I mean that in the everything sense. There's lots of better traders out there than me, such as Mark Minervini, for example, that are making, appear to be making sort of, real and proper returns. I'm just not in that league at the moment. I don't think I'm that far away. I've stated many times that I'm actually playing not bad defense, but I'm just not making serious cash when the going is good. So this is literally an online journal for me to improve. The reason for doing it online is sort of keeps me accountable. It makes me properly sort of think out loud what I'm thinking, and I think it's actually been quite good for me to do it this year. I haven't sort of translated that into big profits yet, but that's the goal of this. And so, once again, this isn't financial advice. If you've got any feedback, please feel free to let me know. If you disagree or agree, I've had sort of one or two comments, which is great. Anyway, moving into it, the video I did on Monday was a little bit manic. Had kids going everywhere, and mentally I was a bit everywhere. So anyway, I'll try and calm it down a bit today. I'm going to stick to a general sort of big picture / market update, and also go through one trade that I've got on. So I thought I'd just start with a big picture. Big fan of Mike Burry, just a very independent thinker. So it gets criticised a bit, but if you read into him, he really is the real deal. He put this tweet up, which struck me as really quite interesting. So he said, let's just read it out. Realise inflation has always been peaky and has never been just one peak. So it resolves to a brief deflation, the 40s, 50s, or disinflation, the 70s, and comes back. Inflationary cycle generally spans years, and inflationary eras have spanned decades. So that was quite interesting, because I was honestly, A, not aware of that, and B, I was thinking interest rates had probably peaked, and we'll come to those charts in a moment, and we were sort of on the way back down. I guess even just thinking about what he's saying there, it actually just makes common sense. So once you've got inflation, you've got all sorts of issues that sort of bubble up through the economy. You've got train drivers who might want to get paid more, then somebody else wants to get paid more, then somebody else wants to get paid more, and everyone's sort of racing to put up prices, and businesses are trying to put up prices, and that may not be successful in that. And so inflation just causes, I think higher inflation causes sort of general instability. And once you've got that, you can't just flick the lights off. And that's when you have the sort of Paul Volcker type areas where you might have sort of aggressive rates and aggressive rises in rates to really stamp it out. But anyway, I think this is a good sort of take home, is that inflation just doesn't get back into the box without some period of time of stamping it out. So if we use that as a good segue to go to MarketSmith, right. Let's go to the 10-year. So this is a daily chart of the 10-year. Was in a stage 1 here, moved to stage 2. So moving averages were supporting it. Nice sort of powerful upswings, pretty straightforward. I can't remember when I was. I think I did more than one video on it, but I think it was around here I was thinking, well, this is probably a stage 3 going into stage 4. The reason for the stage 3 thought was it was just getting really wide and sloppy through here. Bit of a last gap sort of move up, fail. So this is sort of classic stage 3 after a sort of a decent stage 2 move. And I thought, well, when it started to flop down, honestly, took my eye off the ball. I thought interest rates were done, things are settling down, and that's proved not to be the case. It sort of moved back up. So you can probably say that we're actually still in this stage 3 pattern. Now, I've got no idea if interest rates will go up or down. Of course I don't. But we can sort of conclude we're in this period of uncertainty, which is kind of stating the obvious if I say that out loud, but where interest rates are sort of all over the place. You do have the Fed tightening, but also you've got student loans being forgiven, and even like all the perceptions around that about what that means for stimulus. We've got all sorts of issues going all over the place at the moment. So yeah, we've got this uncertainty here. Interest rates are in stage 3 for the time being. That might end up being a new stage 1 going into stage 2. I just don't know. But it was too premature to call the end of it here. And again, if we go back to what Burry was saying, that inflation will span quite a period of time before we can stamp it out. And this chart here, I think, is pretty much confirming that. You can see that here on this other chart. Similar looking pattern, nice long stage 1, move to stage 2, look like a real blow off top here. Failed at 50, you think, oh, it's done, but no, it's not done, at least just yet. So I think we can conclude that there's a bit of choppiness to come, uncertainty. So yeah, okay, I want to go back to one of my favorite graphs. So this is the percentage of NASDAQ 100 stocks trading above the 50-day moving average. Now, I've talked about this loads of times now. When it gets that sort of below that sort of 20 and sort of crosses back up, typically that's a good bottoming signal. I won't continue to beat myself up forever on this, but I didn't take this in because it actually failed a number of times here and I couldn't see the leadership, blah, blah, blah. But anyway, just as it did back in earlier in the year, it does actually give you a pretty good signal that things are just too oversold. We had a really powerful rally, and the number of stocks trading above the 50-day moving average actually rose up to about 90%, which is actually a huge figure. So that's just showing there's a huge amount of, I don't know if bullishness is the right word, because there must have been quite a bit of short covering and sort of all things going on here. But however this was composed, or however it got there, it generally means that things are just too overbought, so we needed to have at least some sort of pullback. Now, yeah, so since then we've had a very major pullback. So the number of stocks trading above the 50-day moving average is actually halved, more than halved. So we had a very big sell-off in those sort of NASDAQ 100 stocks. So much so, I mean, if we have like another day like today, another few days like today, we're almost back at that sort of oversold level, in which case I don't want to be looking to buy. Now, as sort of crazy as that sounds, considering what everyone's talking about in the macro, but anyway, that's what that chart's telling me. Similar story on the number of stocks trading above the 200-day moving average. It got down to what was an historic low of 5. Now, when it gets down below sort of 15 or so, again, it's telling you that the market is definitely oversold, trying to find some sort of bottom or some sort of short-term bottom at least. And again, didn't take it properly, but anyway, big powerful rally up there, and again, those number of stocks is that's almost exactly sort of halved, isn't it? So that are trading above the 200-day moving average. So if we get back down to that sort of 15 or so, which again is not, another few days of this, we're back down there, which is quite remarkable how fast this sell-off has happened. So looking at a few other key indicators, the breadth has been just shocking. The number of stocks making highs versus lows has been swamped by the number of stocks making lows on any sort of time frame, like 52 weeks or 1 month. So that's been in play for a good week or so now. Going to the specific, let's just go to the NASDAQ while we're talking about that so much. Moving averages, are they being supported, acting as support or resistance? So we can see here that the 200-day was roughly the top here, and then acted as a loose resistance here and sort of rolled over. The 10-day moving average didn't provide any support. The 20-day moving average didn't provide any support. Now the 50-day moving average hasn't provided any support. So this is, yeah, not a good sign here. Also note here that this level was roughly the trough of that last period here. So that previous support turned into resistance. So yeah. So you could just see the stars are aligning here a bit. Similar is on the S&P 500. Well, almost identical in terms of the moving averages. The 200-day moving average acted as a perfect resistance point, and so did the other sort of key moving averages that other people are looking at, and so is this previous support here, ish, turned into resistance at this point. So yeah, none of that's a particularly good look. Is the leadership holding up? Well, it sort of is, to be fair. So the three key leaders that I can identify, I should just clarify that the three leaders that people are identifying with, ENPH, to be fair, that's held up, and it's not necessarily a good look, but it's sort of holding that 21-day moving average right at the moment, for at least. It's holding that sort of viable gap up spot here. So hasn't tanked yet. Celsius, not quite as convincing. Sort of had that breakout, pulled back down here, but hasn't really broken down good and proper, to be fair, either. And on broke out, but that's pulled back. So that one's sort of not a disaster or anything, but it's not exactly convincing at the moment. I just want to make a comment on some of these leaders. And I don't have data to back this up, but the prevailing wisdom is retail traders don't have enough money to throw the market around. It's all the hedge funds and institutions that are doing that. And I guess that's right, but one thing that does strike me is that Twitter's done a wonderful job at marshalling a lot of traders together. They form support groups. They're all talking about this, end up talking about the same stocks. There's newsletters that are promoted on there, and so stocks like excuse me, Celsius, for example, strike me as massively followed by traders, retail traders. Now, I get it. It's probably not billions and billions, but equally we don't know. But what I do know is that for a lot of traders there, that means that there's a lot of stop loss orders sitting in computer systems around the world. And so I'm starting to get just a little bit cagey of stocks that are talked about just too much on Twitter. Is it getting sort of too late by the time they start making their rounds, at least too much on Twitter? Don't know. I think a lot of people got good intentions, don't get me wrong. I don't necessarily think there's pumping and dumping, but the chart does look good. They're saying this, and everyone's reading the same thing. And just like with Formula One qualifying, all the smart people are looking at the same data and doing qualifying at the exact same time. So, and therefore, it turns into a bit of a crowded trade. So, yeah, I just got that as a sort of thought there. That I really need to try and be independent and come up with my own sort of thinking. And if that leads me to different names, or even better, names before they become popular, then great. So if I go back to, let's just go back to the NASDAQ. Where does this all wrap up for me? So yes, the lead is sort of holding up okay, but many other indicators are just not. So it's not a buying opportunity for me. So I either call things get double green, which is a sort of a generational opportunity, and that's when the QE starts printing, everything's oversold, like let's go. Or green, which is more of a sort of a tradable, 1 or 2 year type deal. Amber, which is sort of things have been drifting up, and that moved up into an amber phase there. There was sort of money being made, complacency, new bull market, blah blah blah. Or plain red. I know it's not a green or double green at the moment. Whether it's an amber or a red, I don't know. It's sort of borderline more of an amber, the way we're starting to see aggressive selling coming back in here. So I'm gonna sort of call it amber/red. So that means for me, I just need to be trading very lightly, which I have been anyway, very cautiously. yeah, I haven't been trading puts, and I really bloody should do, to tell you the truth. But yeah, just but I'm going to be very open-minded all the same, because like I say, you look at the rapid sell-off here. Now everyone's talking the 50 days gone, it's the end of the world, and you might get some sort of undercut here, and before it sort of powers back up again. So if we get, I'm going to keep very open-minded to that being a possibility, but I'm also going to keep very open-minded to the big picture here. Is really not good on both the S&P and the NASDAQ. So look here, it's sort of come back up to all these sort of previous support points here. Now that's acting as resistance. Same with S&P 500. It's almost picture perfect, really, if I look at that. So could we therefore see a lot more downside to come? Again, especially if those interest rates start picking up, like they have been the last sort of week, we could have a lot more downside to come. So going to stay open-minded at the moment and call it an amber/red. Right. So the one and only trade I've got on at the moment, this is what I'm testing. So I've got, I kid you not, 2 shares in this. Is Digi. I've talked a lot about, do sectors matter? Mark Minervini, there was a good comment on one of my videos that Mark Minervini lets the stocks guide him in, and that might be sort of albeit to weak sectors. The interesting thing was, I should have taken a screenshot of it. So I've bought Digi International. So reason being, clear stage 2, nice looking chart, big sort of viable gap up here, and then consolidated, and it's actually held really quite nicely through this market sell-off. Yesterday was Friday night, when there was a huge down day on the markets. This thing got sold off, but then got bought up quite aggressively. So that's a real vomit situation there. Held its viable gap up level, picture perfect, and then recovered to end up that day positive, and also slightly positive yesterday when the market was down again. So I've bought that, stop loss down here. Why it's only 2 shares? I'm just trying to figure things out at the moment. So the idea, if it rallies a bit, say 10% or so, I sell half into strength, and then try and let the rest run, or if it just gets stopped out, it gets stopped out. So I won't exactly be making a fortune on a 2-share trade on a $33 stock. That was all I had to cover.